Welcome to BigONE Weekly News Update. I'm Sophia. The markets experienced notable turbulence last week as macroeconomic forces reasserted themselves after weeks of AI-driven momentum. Cryptocurrencies, which had surged initially, retraced sharply. Bitcoin, BTC, dropped 5% to around $77,000. Ethereum, ETH, fell nearly 10% to $2,120. And Solana, SOL, slid 11% to $85. Meanwhile, U.S. equities showed signs of slowing momentum. The S&P 500 ended its 7-week winning streak, the longest in over 2 years, rising a mere 0.21% for the week, while the Nasdaq broke a 6-week rally with a modest decline. Commodity markets were more volatile. Crude oil surged over 10%, prompting a sell-off in bonds, with 30-year UK gilts and U.S. Treasury yields reaching highs unseen since 1998 and 2007. The 10-year U.S. Treasury yield briefly approached 4.60%, while the yen and pound hit 1-month-plus lows. After a period dominated by the AI narrative, macroeconomic developments, including hotter-than-expected CPI and PPI readings, rising oil prices, and hawkish Fed expectations, have regained the spotlight. The geopolitical backdrop remains critical. With the situation in Iran unresolved, market participants are closely monitoring potential escalations or negotiations. Crypto markets have shown partial recovery amid these tensions, but Ethereum and other altcoins continue to underperform relative to Bitcoin. Improvements in on-chain activity, DeFi engagement, and real-world applications will be required to shift this trend. Spot Bitcoin ETFs have regained roughly 2/3 of their prior outflows, whereas Ethereum ETFs have recovered less than a third, reflecting persistent investor caution. Futures data mirror this pattern, with BTC positions nearly fully restored while ETH positions lag significantly. Inflationary pressures have also upended expectations for near-term interest rate cuts. Recent U.S. CPI, PPI, and retail sales data exceeded forecasts, erasing market bets on rate reductions. 3 months ago, the market anticipated 2 cuts by year-end. Now, 0 cuts is a realistic scenario, with some even speculating that the next move could be a hike by mid-2027. Labor market conditions, 4.3% unemployment and steady job growth, leave little room for the Fed to act preemptively. Core Fed policymakers, including Powell, Williams, and Jefferson, maintain a higher-for-longer stance, reinforcing the view that monetary policy effects materialize with a lag. Legislative developments are also shaping the landscape. The Clarity Act passed the Senate Banking Committee with a 15-9 vote, moving closer to a full Senate floor vote. The next steps involve reconciling the act with the version passed by the Senate Agriculture Committee in January, with floor debate expected to require a full week. Timing is critical, with a potential floor presentation before July 13 to ensure passage and presidential signature. Looking ahead, key macroeconomic and corporate events will influence market direction. NVIDIA is scheduled to report on Wednesday, testing the sustainability of AI-driven capital expenditure, while Walmart reports on Thursday, offering insights into consumer sentiment amid inflationary pressures. Investors remain keenly focused on how AI trends, inflation, and geopolitical risks will shape risk appetite in the weeks ahead. Join BigONE today and take advantage of the growing cryptocurrency market.